on the 10th of May. Today's article is brought to you by FX Street. US CPI preview. How will inflation data influence Fed rate outlook? Annual CPI inflation in the US is forecast to stay unchanged at 5% in April. Markets are fairly certain that the Fed leave its policy rate unchanged in June. Monthly core CPI reading could influence the Fed's outlook. Inflation in the US, as measured by the change in the CPI, is forecast to stay unchanged at 5% on an annual basis in April. The core CPI, which excludes food and energy prices, is expected to rise 5.5% in the same period, compared to the 5.6% increase recorded in March. Since the year-on-year rate of inflation is subject to base effects, investors will pay close attention to monthly figures to see whether price pressures remain uncomfortably high in April. Market implications. The US Federal Reserve raised policy rate by 25 basis points to the range of 5% to 5.25%. As expected following the May policy meeting, the US Central Bank stopped using the language saying some additional policy firming may be appropriate in its policy statement and revived expectations for a pause in the tightening cycle in June. Although FOMC Chairman Jerome Powell left the door open for one more rate increase by reiterating the data-dependent stance, it failed to persuade investors. According to the CME Group FedWatch tool, markets are pricing a nearly 70% probability the Fed will leave its interest rate unchanged at the upcoming meeting. The US dollar suffered heavy losses against its major rivals in the Fed aftermath last week, and the US dollar index, aka DXY, which tracks the US dollar's performance against a basket of 6 major currencies, came within a touching distance of the multi-month low set at below $101. In mid-April, the risk-averse market environment at the beginning of the new week helps the US dollar stage a rebound, but his steady advance in the DXY depends on hawkish bets making a comeback after the US inflation report. The CPI and the core CPI are both estimated to increase 4% on a monthly basis. In March, the index for shelter, which makes up a third of the core CPI, was by far the biggest contributor to the month-on-month increase in the CPI. Hence, a stronger than expected monthly inflation reading by itself might not be able to convince markets for one more Fed rate hike in June if the shelter index, which tends to reflect price changes with a lag due to the contract lengths, remains as the dominant factor in case core CPI rises more than expected while shelter prices increase at a softening pace. Investors could reassess the Fed's policy outlook and lean toward a rate hike in June. In that scenario, the US dollar should continue to gather strength against its peers in the near term. On the dollar hand, a lower than expected increase in monthly core CPI should allow markets to continue to position themselves for a Fed policy shift and put the US dollar under renewed selling pressure. In the week, the Fed's Senior Loan Officer Opinion Survey, or bank lending practices, reminded investors of tightening financial conditions. The Fed's quarterly publication showed that survey respondents noted tighter standards and weaker demand for commercial and industrial loans to charge and middle market firms. Banks also reported that demand for all commercial real estate loan categories was weakening. On balance, banks are widely reported expecting to tighten their lending standards over the rest of the year, the Fed noted. The Fed is yet to fully understand the impact of the recent banking crisis on economic activity, but a soft core inflation reading in April should buy the Fed some time before it does decide whether it has reached the terminal rate. There you have it, guys. They mentioned the banking crisis. The Fed is looking into that. And another thing they mentioned, the CPI, it's estimated to increase by 0.4% on a monthly basis. So I think that's in line with expectations. In March, the index for shelter. So housing prices are on the rise. In March, the index for shelter, which makes up a third of the core CPI, was by far the biggest contributor to the month-on-month increase. So basically, that's what they're saying. A lot of this inflation is caused by housing prices. So that's in line with expectations, guys. In my opinion, I think the dollar looking forward is still weak. This is just gonna be a retracement that's gonna send us probably to the 105. I'm talking about the DXY. It's gonna send us probably to 105, and that's also gonna cause our indices to retrace as well. So yeah, that's what we can expect, guys. If the number comes out lower than expected, it's gonna be good for the dollar. The dollar might rally, but if it comes out higher than expected, the dollar might just go below $100. Who knows? Let's wait and see. Only time will tell. Don't forget to like and subscribe, guys.